How is everybody doing? You are in the strategy room on this Saturday night, February 15th, 2025, with the banker next door. Great to be here with everybody on this Saturday night, back again. Last week we had to unfortunately move it to Friday night, but we're back here on Saturday night tonight, which is awesome. My Philadelphia Eagles are celebrating their Super Bowl championship this week, which I love. I can't believe it. I mean, kind of been on cloud nine all week because of that, which is fantastic. But have a lot of great stuff in store for everybody here tonight. We're going to be talking about, Jeremy Powell testified this week. Some crazy stuff happened with the CFPB and in effect getting shut down. Could the Trump administration be taking an axe to some other banking regulators? We'll see, maybe. We're going to look at a number of economic indicators. We're going to take a look in on the Fed's balance sheet, the repo market. We're going to take a look at a number of different things there. I'm also going to do my usual stuff. I'm going to talk about some of the episodes I did last week. I'm going to talk about upcoming economic indicators for next week. I'm also going to spend a few minutes tonight talking about some of the books that I'm going to be covering over probably say like the next 4 or 5 months. But let's see here. Let's jump into this first. So again, I've been doing this the last few weeks. I think it's kind of fun to do, but we're looking at and I know this is a little jarring when you kind of look at this on the screen, the U.S. debt clock, just because there's so many crazy numbers on here. But I just wanted to check in on the Doge clock and see what's going on here. The Doge clock being in the upper left-hand corner here. I love the fact that they put this in here. I think it's awesome. So we are approaching almost 100 billion in savings so far from Doge, which I think is pretty remarkable considering they've only ramped up in what's it been about 2 or 3 weeks. Pretty miraculous. I would say doing better than I thought at from the start. But again, gonna have to put at least another zero on that thing to really make a dent, right? We're gonna need somewhere in the neighborhood of if you really want to make a dent in the spending. We need this federal spending to drop here from $7 trillion down to $6 trillion. We need a T. We need a T and an extra zero on the end of this Doge clock here. So, but like I said, good start. I'm very enthusiastic. Good start. And we're gonna see a couple of articles here in a minute that almost had me falling out of my chair this week. Just fantastic. I'm loving it. I'm having too much fun with all of this right now. I absolutely love it. Okay, let's take a look at some economic charts here. I want to talk about a couple of things here because I want to try again. I want to try to show everybody how this stuff all works together. That's the point here. You have to you can't. You look at all these things, you break them down, but you have to try to put them together to really get the full picture of what's going on. So let's start with this. I probably have about 3 or 4 different charts here I want to show everybody, but I want to show you how this all kind of figures together here. So the first thing here, this is the monetary base. So in other words, this is the amount of money that has been pumped into the economy. And this comes from the Fred database, as out of the St. Louis Federal Reserve Bank. Now, when you see here on this chart, what do you notice here? We notice that basically federal spending really began to take off around 2000. 2000 is when the spending really began to take off. You could say here, we're over here, and the monetary base was, right here, 600, 582, 600 around January of 2000. And then we get over here to the financial crisis, 07, 08. And now we're up to, 847. And then we jump to, 1.1. And I'm guessing this is trillions here, 1.1 trillion. And then it just explodes from there. And it just goes right up here. 2015, we're at 3.9 trillion. And then we begin to come back down a little bit to about 3.2. And then obviously COVID, boom. And then we just see this absolute explosion up to 6.4 trillion. And now it has teetered back down, then gone back up, and then come back down a little bit. So, but now we're sitting at about $5.6 trillion in the monetary base right now. And so why is this important? Why are we looking at this chart? We're looking at this chart because this is what is going to key in on inflation. If you want to understand why is inflation up, it's because of spending. It's because of this. We go back to the debt clock, and we see this federal spending here, $7 trillion, $36 trillion in national debt. And we come back to the monetary base, how much money is actually in the economy. And we've got about, there's about $5.6 trillion floating around in the economy right now. But you can see here that the monetary base has absolutely been exploded in the last 25 years. And you again pointing out the absolute explosion here in 2020, just off the charts, going from about 3.4 up to about 6.3. So you can see there how much money was pumped into the economy. So is it any wonder that we had this massive amount of inflation that hit thereafter? Because that is where inflation comes from. Inflation comes from government spending. That's it. End of story. It's the government pumping too much money into the economy. So now we need to shrink this monetary base back down. But you also have to do it in a way that you don't wreck the economy in the process. It becomes a very difficult thing. Now let's take a look at some other things. Here's the Fed's balance sheet. So this is from the Federal Reserve website. And I just wanted to show you guys how this kind of lines up with the Fed's balance sheet. So when we go back here to the monetary base, we see this jump from 2010. We see this jump up here up to about 2015, and it comes back down, and then it jumps back up. Now, how does that measure up with the Fed's balance sheet here? Oh, here's 2010. Oh, here's this jump up. Oh, wait, there it goes up to 2015, and it's at an all-time high. For the moment, jumps up to $4.5 trillion on their balance sheet. Goes from, they had about 50 billion on their balance sheet in 07-08. And then it shot up to by at the end of 2008, they were up to 2.2 trillion. By 2015, they were up to $4.5 trillion. And then look, it starts to come back down a little bit. And then what do we get? Boom, COVID hits, and we're all up, and they hit about $9 trillion here at the peak. Now, it's been coming back down. The Fed has entered, and this was if we see at the chart here, so this is 2002. If everybody can see where I'm kind of pointing here. So 2002, you're kind of almost at the peak here. So you're about a March of 2022. And then what did they start doing around March of 2022? Oh, that's right. They started increasing interest rates, and they started doing what they call, instead of quantitative easing, they now wanted to do quantitative tightening, where they wanted to increase interest rates. They wanted to not be accommodative anymore, and they wanted to begin to bring the balance sheet down. So they've brought the balance sheet down now to about 6.8 trillion, which is pretty good. I mean, they've effectively taken about $2.1 trillion off their balance sheet. They took it down from, like I said, almost 9 trillion from 8.9, and they've taken it down to 6.8. So, but again, I just want you to see how the balance sheet of the Fed also mirrors the monetary base. And you can see this again, the same thing here. Monetary base gets up to 6.8, and then it begins to come back down, begins to trend back down here. Fed's balance sheet jumps all right up and begins to tread back down here. So these things, so again, they might seem like two separate things, the monetary base, the Federal Reserve's balance sheet, but they're more closely correlated than you realize. That's what I'm pointing it out. Now let's take a look at the repo market. I pointed this out last week. So again, this is from the Fred database. Let's look at the repo market. We saw this, we've seen since 2021, since January of 2021, we saw this huge jump up in the repo market, which culminated in about $2.5 trillion in the repo market. And that was in January of 23. We had 2.5 trillion in the repo market, and now that has plunged all the way back down to 58. Where are we at here? About 67, 50. Oh, no, February 14th, Friday, we closed at $58 billion in the repo market. That's a problem. That's a huge problem. And I don't understand why the news media like this. What you have to understand, I said this last week, what you have to understand about the repo market is this is the market that provides the liquidity for the entire financial system. Starting back in 08, 09, 010, one of the big underlying mechanisms, if you will, of the financial system, the Fed basically took the repo market and put it at the very heart of the financial system. That was one of the big changes that they made to the financial world. And again, CNBC, this is one of the reasons why I kind of despise the coverage on CNBC, because these guys, it's just, they're like, who could have seen it coming? Who could have seen it coming? I don't know. Anybody could have seen it coming if you spend 5 minutes looking at this stuff. But this is a big problem. So I just want to point out, like, look at all the things you've got going on here. And now let's take a look at gold for a second here, because I want to point this out. So gold prices. So the live gold price hit $2,883. Technically an all-time high. If you adjust for inflation, the all-time high percentage-wise with inflation to match where it was, I think, in January of 1980, I think you would have to get gold prices probably up to around $3,400. Not that far away. You're only talking about another $400 or $500 there to basically hit an all-time high on an inflation-adjusted basis. Right now, from just a dollar basis, we're at gold has hit an all-time high. But look at the chart here. We have seen since December of last year, gold has gone from basically 2,600 and has jumped up to 283. So it's gone up almost $300 in just the last 8 weeks. It has made a huge jump up. Why now? Why? Well, that's the big question, right? Why has gold jumped the way it has? Well, it's jumped the way it has because people think the Federal Reserve is doing a horrible job of managing the economy. They think that the Treasury has left us in a horrible spot, which Janet Yellen absolutely did. Jeremy Powell and these guys have done a horrible job of running this, and we're going to see here in a second that this Fed pivot to basically decide, we're going to start lowering interest rates again, and we've seen inflation now spike back up. This might be one of the, it's hard to say it's the worst, because obviously we saw what happened in the 70s. The 70s, in my mind, is still the worst Fed pivot, but this is not that far behind. This is pretty darn close. But again, it's like CNBC and Bloomberg, these guys, it's like they only want to cover this stuff when it benefits them in some way to cover it. Outside of that, most of the time they're brain dead. They just, they like taking their trips to Davos and crap like that. And that's what they're really focused on, being outside on a fake set with putting their coat on in Davos, with the mountains in the background. Oh, it's so cold, and we're just roughing it here in Davos as they're literally in the pinnacle of decadence there in Davos, staying in the Four Seasons Hotel or the Waldorf Astoria, or wherever they're at. It's a joke. Anyway, I'll get off my soapbox there for a second. Okay, so back to the main point at hand. So gold is just jumping here, and the reason why it's jumping is that first of all, people are looking at gold as a hedge against inflation. That's part of it. But a big part of it is this. It's actually the central banks that are buying gold. They're buying the gold because of where the dollar is and where everything and where the financial situation is. They're buying gold because of this $36 trillion national debt here. The gold buying by the central banks has been absolutely unbelievable for the last 4 years. But again, I said, when you look at gold is the ultimate critique. The price of gold is the ultimate critique of the central bankers, okay? And not just here in America, but all over the world. If gold is down, if gold is $500, then the central bankers are doing a pretty good job. If gold's in an all-time high, it's almost $3,000. That tells you that people are very afraid, and the central bankers are doing a garbage job. So the question becomes here: we have a monetary base that's come down a little bit, but is still way too high. We have the Federal Reserve tightening and they've brought their balance sheet down now to 6.8 trillion, but still way too high. They want to keep bringing it down. We have a repo market that almost all the liquidity is gone out of the repo market. And now we've got gold shooting to an all-time high. I want everybody to see how these things are all interconnected. They all work together, and that's the whole point of this. So the question is, how much longer can the Fed keep doing this? How much longer can they keep their quantitative tightening going? Reducing this, because you got to remember, remember interest rates were down to zero for the better part of 15, 16 years. Why is that? They did it because the Fed used quantitative easing to manipulate interest rates, particularly short-term interest rates, which they kept very low. They kept artificially low. Now all of a sudden they're like, oh, well, we can't control that. We don't have any control over that. Okay. We're all supposed to buy that one, right? And I get that they want to keep bringing this down, but the problem is that doing this right now is the worst thing that you could be doing to the economy right now. They're draining the money out of the repo market. They are reducing their balance sheet, and they are reducing the monetary supply, and gold is going nuts as a result. And again, when you look at all this together in context, you begin to see a different picture. All of a sudden, it's like some of this stuff starts to make sense. You're like, oh, okay, I'm starting to get it. The Federal Reserve, they're reducing their balance sheet. They're bringing down the monetary base. They're bringing down the liquidity in the repo market. Okay, I see what's going on here. Now I see why gold is jumping up, because people are like, yeah, they don't like seeing those other things. So, this is where we're at right now. And I'm going to get into, Powell's testimony this week. And we're going to look at that in just a minute. I want to get to a couple other big things that happened this week first, but I'm kind of setting the stage here by showing everybody all these charts here at the beginning and kind of painting the picture for how these things work. I'm kind of setting the stage here for what we're going to talk about here over the next half hour when we get into what the Fed did this week, all the economic indicators, what's going on with inflation. We're going to, so just hang with me. There's a point to all this. And then I'm going to show you this book right here. So this, if everybody can see that there, I know there's a glare, but this is called Trading Intermarket Analysis. And this book was written by John Murphy. This is a book that I want to get into in the coming months. So intermarket analysis. John Murphy is a genius out there. He wrote a very famous finance book called the Visual Investor, and all about technical analysis. He was John was one of kind of the original guys on CNBC about 30 years ago, going back to the mid to late 90s. He was always on there talking about what's known as technical analysis, the analysis of basically, chart analysis. And he was one of the early, like I said, one of the very early first guys on CNBC who would basically put the charts up there and then talk about the charts and what they meant and how to analyze them and what different, velocity, resistance, all this, he would talk about all these different technical aspects of analyzing charts. But then John also wrote this book on intermarket analysis, and intermarket analysis is just that. It's how does one thing affect another? How does the dollar affect currency or commodities? How does commodities affect the dollar? How does oil affect the dollar? How does the dollar affect oil? How do all these different components of the market interact and then ultimately affect each other? And that's something I'm going to talk about a lot in the weeks and months ahead. It's something I'm going to focus on, because in order to get the full picture and really understand what's going on with the economy, you have to understand intermarket analysis. Like, you have to understand how these things work together. How does one thing influence the other thing in terms of the overall economy? So, okay. All right, let's get into some other things here. So, big news of the week. Consumer Financial Protection Bureau staff told to stand down from all work. Some people out there in the banking industry probably didn't like this. I loved it. I absolutely loved it. I don't like the CFPB. I haven't liked the CFPB. I didn't like it when they got created in 2008. And, I know that, there's some politicians out there. We're not going to name names, but you know who they are, who, are basically out there, kind of weaving this fairy tale that like, oh, what are consumers going to do if the CFPB is not there to take their complaints or whatever? Newsflash: the CFPB didn't do anything with your complaints anyway. Please, somebody tell me. I would love for somebody to give me an example of all the amazing work that the CFPB has done helping consumers. Okay, I would love to see that. Which is nothing. So, but anyway, so what happened here? So the Consumer Financial Protection employees were told on last Sunday, to stay at home because their Washington, D.C. headquarters would be closed through February 14th yesterday, according to a memo obtained by CNBC. The memo from CFPB Chief Operating Officer Adam Martinez follows an email sent Saturday from newly installed acting CFP Director Russell Vaught, which instructed staff to suspend nearly all activities of the regulator, including supervisory financial firms. On Monday morning, Vaught reiterated the message in an agency-wide email to staff, saying that employees needed clearance from Chief Legal Officer Mark Paletto to do anything related to CFPB business. Otherwise, employees should stand down from performing any work task. The developments come amid concern about the fate of CFPB and its staff after operatives from Elon Musk's Department of Government Efficiency arrived at the regulator late last week. The Doge employees have been given access to CFPB data sources, including staff performance reviews, said people with knowledge of the situation who have asked for anonymity out of fear of reprisal. Musk, who last year called for the deletion of the CFPB on Friday, posted CFPB RIP on his X social media platform. Besides putting a freeze on nearly all CFPB activity with his inaugural memo, Vaught on Saturday posted on X that he was halting the flow of fresh funding to the agency. This spigot, long contributed to CFPB's unaccountability, is now being turned off, Vaught wrote. And in layoffs, CFPB employees are bracing for the possibility of being put on administrative leave or laid off, similar to what Trump officials have attempted with the U.S. Agency for International Development. While there are roughly 1,700 CFPB employees, only a few hundred workers have positions which are mandated by law to exist, according to a person with knowledge of the agency. Further, CFPB employees were told by management that the Trump administration's buyout offer for federal employees is valid and that the agency would respect its terms, said the person. There are a lot of people who are very anxious trying to figure out whether to take the deal. Mass layoffs or resignations would jeopardize the mission of the CFPB, created in the aftermath of the 2008 financial crisis to prevent banks and other financial firms from exploiting Americans. Bank trade groups have long accused the CFPB of being unfair and have fought the agency rules in court, even unsuccessfully attempting to declare the agency unconstitutional. At risk of several CFPB efforts that would have saved consumers tens of billions of dollars include restrictions on credit card and overdraft fees and a rule that would have removed $49 billion in medical bills from the credit reports of 15 million Americans. Despite the court ruling, despite what the Supreme Court ruled, I believe that the CFPB is unconstitutional. I believe that, the way that they were funding, the funding mechanism, which was really the thing that bank trade groups went after, was unconstitutional. I don't like the fact that a lot of people think that the CFPB is like the OCC or the FDIC, that they're like this separate organization. They're not a separate organization. They're part of the Federal Reserve. They're underneath the umbrella of the Federal Reserve. And I think that has always been one of the big problems with the CFPB. I think if you were going to create it, and this is why the whole funding thing was attacked through the appropriations and the Federal Reserve and what the Federal Reserve has to do with this. But the CFPB, the big problem with it in the last, 10, 12 years, it's just become this political arm. And basically whoever was in power sought to use the thing as a political weapon to just push their agenda and push out whatever they wanted to do. The CFPB is a big reason why we had the Chevron doctrine, why Chevron got overturned by the Supreme Court last year, because the CFPB, like many federal regulators out there, they would just put out these rules that they would just consider then to be law. And there was really no way to challenge these things. Now there is a way to challenge them. Now they can be sued. They can be taken into court. These things that they put out can be challenged. So again, I like I said, I think this is a good thing. I think this will save taxpayers a lot of money. I think it's just, there are too many regulators to begin with. I truly believe that. And the more consolidation that you have in the banking business, the less need you have for all these regulators. This is a point that I have tried to make over the years to some regulator friends of mine, is that, hey, look, the more you allow the banking business to become consolidated, the more you are basically going to work yourself out of a job. Like you look at the FDIC. The FDIC, I think, has 6,000 employees with like a $3 plus billion budget. Does the FDIC need 6,000 employees? Do they need a $3 billion budget? I seriously doubt it. I think you could probably cut that place in half. Probably cut $1 billion off their budget, no problem, and they would still operate as normal. And I think that's true of probably dozens, if not 100 other government agencies out there. Now, again, I'm sure there's a lot of people in the banking business who probably would disagree with me on that. There's probably a lot of regulators that would disagree with me on that, and that's fine. They could do that. I'm just, like I said, this is just my take on it. So, okay, why? All right, let's see here. Now, let's moving on here though. So, Trump advisors eye bank regulator consolidation after targeting the CFPB. So they weren't, after the CFPB was done, they weren't done. They kept going. Pathways under discussion would attempt to merge the FDIC and the OCC without Congress. So the Trump administration officials are discussing plans to curtail and combine the power of banking regulators without Congress's input. In recent discussions, Trump advisors and allies have examined whether it is possible to collapse the FDIC into the Treasury Department. According to people familiar with the matter, they have also discussed combining the FDIC's regulatory role with the Office of the Comptroller of the Currency, in other words, the OCC, under Treasury. The Trump administration has also taken aim at one financial regulator, the CFPB. President Trump over the weekend installed Russ Vaught. Yeah, we heard about that. Staff inside the FDIC and the OCC expect to hear from DOJ soon, according to people familiar with the matter. Discussions on how to shrink, consolidate, or even eliminate the bank regulators have been underway since at least late last year, the Wall Street Journal previously reported. Those discussions included combining or otherwise restructuring the FDIC, the OCC, and the Federal Reserve supervision role, the Journal reported. Some Trump allies have pushed for a political loyalist to be named the Fed's vice chair for supervision. Some of the people said bankers have advocated for the role to be filled by Fed Governor Michelle Mickey Bowman and have pressed the administration to move quickly. The discussions are fluid, and it wasn't clear what changes would ultimately be proposed. The administration wants at least de facto consolidation of the bank regulators, even if the agencies remain separate entities. It's unclear whether the administration could do that on its own. Congressional support would be needed to officially combine agencies. In a recent proposal, one individual would lead both the OCC and the FDIC. People familiar with the matter said that would allow the OCC to attempt to take over all of the FDIC's work supervising banks and potentially its role winding down failed banks, the people said. The FDIC, which is funded by insurance premiums paid by banks, would be left in charge of deposit insurance. There have been separate discussions to also tap that individual as the Undersecretary for Domestic Finance at Treasury, which helps advise and carry out policies for the department. In any plan that advances, significant cuts are likely at the bank regulators. Trump has moved to freeze hiring in federal government and force workers back to the office full time. DOJ has been the main driver of cuts. Bank executives have been telling Trump their industry suffers under too much regulation. For years, the CEOs have argued other industries are encroaching on their business without the same regulatory hurdles. Bankers have remained broadly optimistic that Trump's administration will have a friendlier stance toward capital requirements, mergers and acquisitions, and technology partnerships. But they would be wary if any changes threaten to undermine even the perception of the ability for the government to ensure deposits, monitor risks, and coordinate orderly closures across the more than 4,000 banks in the country. Some bankers have called for the expansion of deposit insurance, particularly in the wake of several bank failures in 2023. Not all banks are against a system of multiple regulators, which allows them to shop around for a lighter touch and work with staff familiar with their size and complexity. Yes, that is very true. However, if everything was even-handed, there would be no need for the bankers to shop around to try to find different regulators. And that kind of paints the picture for you that there are too many regulators to begin with. If bankers are shopping around to find the right regulator, it's like it's like Goldilocks. Like, this regulator was too big, this regulator was too small, this regulator was just right. I mean, that tells you right there that there's a problem. But this could get really big really fast. I mean, we are absolutely on the cusp of some monumental changes that these are generational changes that we have not seen in a long, long time. And it is, obviously it's a little unsettling in certain respects for the market. It's a little unnerving because, again, banks, the financial system, the markets, they don't like uncertainty. However, I think that a lot of the changes and stuff, I think this is a lot of stuff that's long overdue. It's long overdue, and I think a lot of this stuff needs to happen. Banks have been overregulated for a long time, I have been of the opinion, I don't think you need to have 6, 7, 8, 9, 10, 12 bank regulators out there. I think there are currently like 18 different regulators that banks have to deal with in various one way, shape, or form. It's a lot. It's a lot to deal with year in and year out. And then one regulator passes a rule. But then, and then sometimes you get the regulators fighting with each other about how, look, the CRA is a perfect example. You got the FDIC, the Fed, the OCC, all putting their input into the CRA, and it turned into a hot mess. And that's just one example. And now we're trying to, get that all entangled and figured it out. But I for one I am super excited. I am super ecstatic about this. And again, I'm very hopeful that this will lead to some positive things. I think, you could make the argument when there are 10,000, 15,000 banks in the country, like there were back in 1980. You could make the argument that, we needed all these different regulators and everything like that. When, we're down to basically 4,500, 4,600 banks in this country. And if things continue the way they are, those numbers could shrink down to less than 3,000 in the next, 15 years. So therefore, you got to ask yourself, if you're only going to have, 3,000 banks, do you need to have all these regulators with tens of thousands of employees and and billions and tens of billions of dollars? Count up the budgets and the employees for all those 18 regulators across the board. You're talking about you could probably be talking upwards of $30 billion. Do you? And I think that's a legitimate question to ask. Do you need all that? Do you need all these regulators? Do you need these massive budgets? Do you need, I think that we will get an answer to that question very shortly. Here's the big one though. Here's the big daddy. Here it is. Something that I thought I would never see in my life. The IRS to be audited by Doge, Trump says. I almost fell out of my seat when I saw this. This is something that I never thought I would see in my entire life. It's wonderful to see the shoe on the other foot for once, even if it's just once in my life. To see the IRS on their heels because somebody's climbing up their butt. Okay. Yeah. Yeah. Am I loving this? I am loving it. I am ecstatic. I can't believe it. It's fantastic. I think that there are tens, hundreds of millions of people out there right now cheering this on, going, yeah, yeah, finally. So the IRS will be audited by Doge. President Donald Trump said on February 13th, the Internal Revenue Service will be looked at like everybody else. Trump told reporters at the White House in Washington. He said that just about every federal agency will be examined by Doge. They're doing a heck of a job. It's an amazing job they're doing, Trump said. I call it the force of super geniuses, but it's building. And they go up and they talk to some of the people about certain deals and they get tongue-tied because these people get it. They're very smart people. We need smart people. The IRS declined to comment on the remarks. Of course they did. They're sweating bullets right now. Trump was responding to a question about how Doge reportedly arrived at the IRS on Thursday and whether he wanted to close the IRS. Trump said he did not expect the IRS, which is currently processing 2024 taxes, to be shuttered. Senator Ron Wyden said on social media platform X that his office has heard that Doge is at the IRS. That means Musk's henchmen are in a position to dig through a trove of data about every taxpayer in America. And if your refund is delayed, they could very well be the reason. Dude, give me a break. No, dude, they're not looking at anybody's. No, they're not looking at tax returns. They're looking at the budget. They're looking at the money. They're looking at how efficiently is your organization, is your government agency operating? How efficient is the agency operating? What are they doing with our taxpayer dollars? That's the thing. I mean, when you look at the breadth of money that has been discovered going in places that it shouldn't at, or things that are just outright fraud. I mean, just hundreds of billions of dollars. They found when they went into the Treasury, they found that like $2.7 trillion of Medicaid money had been taken and shipped overseas for who knows what. I mean, the amount of just money that is just being dumped out of control through the federal government into places that it shouldn't be is just, I mean, it's mind-boggling. And I think it's going to get worse as Doge goes through every single one of these government regulators, and they go through, and they didn't even get to the Pentagon yet. Wait till they get to the Pentagon. But I have no doubt they're going to find that the Treasury was using money ways that it shouldn't be used, that the IRS was using monies the way that it shouldn't be used, wasting our taxpayer dollars. So yes, do I want them to audit everything in the government and come back with a whole bunch of cuts and make sure that our tax dollars are being used in the appropriate fashion? You better believe it. You better believe it. So, but this is awesome. This is, I can't even explain how like tickled to death I am to see this. Absolutely amazing. All right. So let's talk about Jeremy Powell testifying this week. Here's the official press release from the Board of Governors of the Federal Reserve. So Chairman Powell, he submitted identical remarks to the Committee on Financial Services, the U.S. House of Representatives, on February 12th. So what does it say here? Current economic situation and outlook. So recent indicators suggest that economic activity has continued to expand at a solid pace. Gross domestic product rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months following earlier increases. The employment rate has been steady since the middle of last year at 4% in January, remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Total personal consumption expenditures, the PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of household, businesses, and forecasters, as well as measures from financial markets. And then it gets into monetary policy. Our actions are guided by our dual mandate. Let me conclude by emphasizing that at the Fed, we will do everything we can to achieve the two goals Congress set for monetary policy: maximizing employment and stable prices. We remain committed to supporting maximum employment, bringing inflation stability to our 2% goal, and keeping long-term inflation expectations well anchored. Our success is delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service of our public mission. Yeah, okay. That's a load up. Happy you know what, okay? That is exactly what that is right there. First of all, as I have demonstrated, okay, and analyzing the job reports, the labor market is nowhere near as strong as what it appears. A lot of these numbers are nonsense. I'm going to show you guys something right here. If I could find this. Let me see if I can go down here. I'm looking for a Zero Hedge article here that came out this week. Where is it? Where is it? Come on. Where are you at? Hang on. Bear with me for a second, guys. It's here. It's here. I know it's here. I might have gone all the way back here. All right. I can't seem to. Cannot seem to find this. All right, I'll have to come back to that. But basically, the Zero Hedge article was Politico saying in effect that we looked at all the economic data and it was wrong, and Zero Hedge just said, oh, geez. Yeah, we've been telling you that for over 12 months now. We've been telling you that. All right, so let's go on here. So then here is the actual report itself. I went back and actually got this out. So this is the semi-annual monetary policy report. So this was for February of 2025. If anybody wants to, I'm not going to go through this whole thing, but I just wanted to show it to you guys in case you wanted to go read it. It has a summary, recent economic and financial developments, monetary policy, and so on and so forth. But this is out there for anybody who wants to go to look at it. But let's look at the heart of the real thing going on here. Why the Fed is mostly powerless to lower housing inflation. That's interesting because they said everything that they do is about, controlling that mandate and bringing inflation down to 2%. Have they managed to bring inflation down to 2%? Have they managed to bring it down anywhere near 2%? The answer to that would be no, an absolute emphatic no. How about no, Scotty? How about no? Little Austin Powers there for everybody. All right. So Federal Reserve Chairman Jeremy Powell Tuesday acknowledged the Fed has limited ability to influence housing costs despite the central bank's mandate to control inflation. Oh, that's interesting. That's interesting. That's a very different tone from the press release, isn't it? The Fed's main tool for controlling inflation, the federal funds rate, influences borrowing costs for short-term loans, but cannot directly move rates for long-term loans like the 30-year mortgage. That is correct. That is what this is all about. The monetary tightening. This is what is, in a very real way, influencing those long-term rates. If they would stop doing this, if they would ease the throttle back on this, okay, that would help. But they don't want to. Jeremy Powell doesn't want to, but he doesn't want to tell you that in his testimony. A long-standing housing shortage may push up housing costs regardless of what the Fed does with interest rates. That is true. The Federal Reserve's job is to control inflation, really, which they've done a bang up job with, but has little ability to influence one of its biggest drivers. Fed Chairman Powell acknowledged at a congressional hearing Tuesday. Housing is the biggest expense in most people's budgets, and it's also by far the largest component in the official cost of living measures that the Fed uses to gauge inflation. While the Fed can put its thumb on the scales of the economy to influence inflation broadly, there's little it can do to lower mortgage bills, Powell said Tuesday at a hearing of the Senate Finance Committee, delivering the Fed's twice-yearly report on monetary policy. Home prices surged during the pandemic. We all know that. Treasury yields play an important role. Despite the Fed's role in driving up mortgage rates, the central bank is limited in its ability to bring them down. Oh, really? Because I thought that they did that for 16 years, brought them down to almost zero, as a matter of fact. The Fed's funds rate dictates the rate at which banks can lend money to one another and heavily influences short-term rates for all kinds of loans, including credit cards and car loans. Yes, everything you do in your life is tied to the 10-year Treasury. I've said that 100 times. The 30-year mortgage rate, on the other hand, is closely related to a different financial instrument, yields on the 10-year Treasury. Ah, yes. Those yields are influenced by the expectations of bond traders about what the Fed funds rate will be in the future. Treasury yields are higher than normal now for many reasons, including investor expectations about inflation, whether or not there will be a recession, and other factors. No. Do you know why the bond yields are up? For two very big reasons. Number one, this right here, the $36 trillion in national debt. And because of what Janet Yellen has done to us at the Treasury, with the manipulation of the short-term rates, what was deemed as ATI, activist Treasury issuance. That is why we are in those are the two main reasons why the bond market is in where it is. All right, so now let's look at a couple other things here. So, for CEOs and bankers, the Trump euphoria is fading fast. Deals market gets curtailed by uncertainty delivered in president's first weeks. So this was in the Wall Street Journal. Now, I want to put a caveat to this before we look into this a little bit deeper. I want to put a caveat. It is obvious to anybody, if you are, Rupert Murdoch, who owns the Wall Street Journal and owns Fox News, he hates Donald Trump. Absolutely hates him. He did everything in his power to make sure that Donald Trump could not get reelected. That is not a secret. Everybody knows that. Everybody understands that. And it is obvious to anybody anybody who reads the Wall Street Journal every day, reads it every week, has been reading it. I've been reading the Wall Street Journal for 30 years. It is obvious to anybody that the articles have become, within the last 3 weeks, they've become insanely slanted towards basically everybody and everything hates Trump. So I put that caveat out there because, again, this idea that the euphoria is fading fast and there's all this uncertainty and blah blah blah, no, I do not believe that to be the case. And then of course this article is a very of course negative article. It took less than a month for the second Trump administration to cool the enthusiasm of chief executives and deal makers. Consumer sentiment is down and inflation expectations are rising, driven in part by worries about the impact of a threatened trade war. The deals market just ended its quietest January in a decade, and a Justice Department that was expected to wave through acquisitions instead sued to block a big technology merger. Corporate bigwigs are now using phrases like fragility, volatility, and wait and see to describe their outlooks. Nobody knows what's up. It's like being on Space Mountain at Disney World. You get on Space Mountain, you get in a car, and you're in the dark, and the cars go left and right, and abrupt turns. You don't know where you're going, but you're pretty confident that you're going to get to the right place at the bottom. Deals are down so far, but this is going to take time. I mean, the thing that all of us have to remember is that if Trump is successful in doing a lot of the things that he wants to do, it's going to take time. It's going to take multiple years. It's not going to happen in a couple weeks or even a couple of months. This is stuff that's going to take a while. He walked into just a cataclysmic mess cataclysmic mess. And it is going to take a while to fix a lot of this stuff. It's not going to be fixed overnight. And unfortunately, a lot of it is probably going to take longer than a lot of us, for us to like, to get a lot of this stuff fixed. But I believe that when we look back 12 months from now, 24 months from now, things are going to be a million times better than they were a couple weeks. And they're already better. Just a few weeks in, they're already better. Okay, but here's an important article. Wall Street is nervous about Scott Bessent's borrowing plans. Again, another negative article here from the Wall Street Journal. And I can guarantee you all in the coming weeks and months, we're going to see a lot of this. So, new Treasury Secretary has criticized a borrowing strategy that helped calm markets. And I want to tear this thing apart. The prospect of increased borrowing by a second Trump administration has spooked bond investors in recent months. One major concern, how the government will execute that borrowing. At issue is a strategy pursued by the Treasury Department since late 2023 to lean more on short-term treasuries to fund the government. Yes, this is the crap that Janet Yellen did to artificially keep interest rates down. This is the manipulation on her part of the market, and she left us she drained the cash account at the Treasury. There was 1.6 trillion in there, and she drained it $1 trillion and left us with 600 billion. She left us the first day of Trump coming into office. They had to immediately go into emergency measures because of what she did. And she left us with $9 trillion having to be rolled over because, again, of what she did. She left us with a colossal mess. I've been saying that. If you watch these live streams for the last few months, I've been saying it for months. She left us with a colossal mess. And now this clown who wrote this article, let's see this, Sam Goldfarb. Sam. This clown writing this article here, basically saying that he's, they're worried that, he's going to change this approach. Well, first of all, he has to change the approach because you have to. You couldn't keep doing this. Nobody could keep doing this. You're bankrupting the Treasury. But anyway, I digress. Let's continue here. So many on Wall Street credit that approach with calming markets buffeted by sticky inflation and a swollen federal budget deficit. Yes, but it was a gimmick. Yes, it did calm markets for the short term, for a year, but it was a gimmick, and it was a gimmick that was done to try to get Biden reelected, and that was it. And she toyed around. She kept the yield curve inverted unnecessarily to not have the market go into a recession. Man, this just gets me fired up. So, but key members of the Trump administration, however, have expressed hostility to the strategy, as they should, characterizing it as a risky effort to juice the economy. Exactly right. Those include freshly confirmed Treasury Secretary Scott Bessent and Stephen Mirren, the president's choice to chair the Council of Economic Advisors. Investors have generally welcomed Bessent's appointment, seeing the former hedge fund manager as a potential moderating influence on President Trump on issues such as deficit spending and tariffs. Still, some worry that he might ramp up issuance of long-term debt, or duration in Wall Street parlance, putting upward pressure on already elevated U.S. Treasury yields, a key benchmark for borrowing costs throughout the economy. That has raised the stakes for Wednesday's release of Treasury's quarterly borrowing plans. So, but here's the thing. They're saying that some worry that he might ramp up issuance of long-term debt. He has no choice but to ramp up issuance of long-term debt. He has to roll over the short-term debt that Janet Yellen put us in. He has to roll that over into longer yielding Treasury bonds and notes. He has to do that. He can't not do that. Like that. So for them to say that he might do this as part of his overall strategy. Well, no, he's going to have to do it. It's not a choice. He's going to have to do it. And it is going to drive yields up. That is going to happen. So if they're legitimately of that view, the Treasury should have been adhering to a policy of issuing more duration and less bills, then that could be a big deal for yield, said Blake Gwynn, head of U.S. Rate strategy at RBC Capital Markets. Investors care about the federal deficit because filling a larger budget shortfall requires selling more treasuries. That can drive down the prices of existing bonds, pushing yields higher. Details matter, however. Borrowing in T-bills debt that matures in a year or less typically has little impact on the 10-year Treasury yield, which is what moves things like mortgage rates. Investors don't expect Treasuries to change the size of its note and bond auctions this week. The agency typically telegraphs such adjustments well in advance and said in October that it didn't expect changes to long-term debt auctions for at least the next several quarters. And then we got a chart here of the 10-year U.S. Treasury yield. Investors instead will be checking for changes to that guidance, in particular, whether Treasury at least opens the door to increases in the second half of the year. Many analysts have been anticipating such a move even before the change in administration. Given the government's projected borrowing needs, the Congressional Budget Office recently forecast a fiscal 2025 budget deficit of nearly $1.9 trillion. I got bad news for everybody. That budget deficit is going to be much worse. It's going to, right now, we are on pace with numbers that came out this week to be at a $2.5 trillion, $2.5 trillion budget deficit. That's where we're at so far. And we're on pace. We're already through the first 3 months of the year. I think we're already at over 800 billion through the first, couple of months of the year already. Absent increases in long-term debt issuance, Treasury would need to rely more on T-bills to meet its funding requirements. T-bills are usually considered as safe as cash, offer advantages to the government as a low-cost funding tool. A downside is that they make borrowing costs more variable. Demand from investors may also not be unlimited, so Treasury has historically reduced the share of T-bills during economic expansions to leave room for big increases during downturns. T-bills made up around 22% of the government's stock of debt at the end of December, up from 15% 2 years earlier, though still a touch below the long-term average. So, and then, we could go on here. But that's the basic gist of the article here. And, it just drives me nuts because this is just nonsense. It's like, it's creating fear mongering. It is, putting out what I feel is a very biased opinion about what's going on. It's putting out a very disingenuous opinion about what's going on. It's not being realistic about the things that Janet Yellen did and the position that she left us in. And basically already questioning, what's Scott Bessent going to do? And this guy's going to wreck because really what they're saying there, if you read between the lines, what they're really saying is that Scott Bessent's going to wreck the economy. Trump's going to wreck the economy by doing this. Whereas Janet Yellen was Grandma Janet, she was just awesome. She was the bestest ever. And, and how could you question her as the Treasury Secretary? Yeah. Okay. All right, where are we at here? We are about 57 minutes in here. So, all right. So before I get to inflation and all this other good stuff, let me take a minute here, as I usually do this time of the program. And I want to run through real quick, what have I been working on this week? What were the 5 episodes that I put out this week? So hold on a second. I'm not getting paid for this, by the way. Coke. Hey, Coke, if you want to give me a sponsorship deal, please, would love it. All right. So on Monday, I put out episode 317, which was the ABA, the American Bankers Association, their blueprint for 2025. So they did a big press release, put out their whole, what's our plan for 2025? What's our agenda? And I wanted to cover that because I've covered a lot of like the ICBA, the Independent Community Bankers Association. But ABA is if you want to consider them the biggest, baddest, banking trade association around. They are that, in fact, and they carry a lot of weight up there on Capitol Hill. So obviously it's important to look at what it is that they're focused on. So I kind of covered all that in episode 317, if you want to go check that out. Episode 318 on Tuesday was what types of payments did small businesses use in 2024? And that was kind of an interesting episode because it looked at 4 main payment channels. It looked at basically cash, at checks, at ACHs, and what was the third one? cash checks, ACHs, and why am I drawing a blank on the third one? Was it wires? Might have been wires. But again, it was interesting. Like, what were the uses there, and how different industries used different things? Like retail and hospitality versus financial services versus some different things, healthcare. So it was interesting to see, the different and not necessarily a lot of surprising stuff there, but still some things. But what you find out is that checks and cash are still, as much as people are using more ACHs, they're using more wires, they're using more like PayPal with Venmo and stuff like that. As much as that is still happening, checks and cash are still very, very prevalent and very, very strong in the overall economy. And then on Wednesday, I had a probably one of the most important episodes I've done, which is I did an interview with Mickey Marshall from the ICBA, where we talked about open banking. We had a whole discussion about open banking. So if everyone remembers, a few weeks back, I did episode and that was in January. So January 13th, I did episode 298, which was 1033 rule, aka open banking update. So, and I basically tried to break down the whole, what is open banking? How did we get there? What's going on right now? And I basically just said, hey, ICBA put out this open banking guide. You should go check it out, just to try to bring awareness to the issue of open banking and try to explore that. So, but I called up the ICBA, Mickey Marshall, who's one of their main regulatory people over there. He was kind enough to come on and basically discuss open banking. We walked through the open banking guide that ICBA put together, and we talked all different aspects of open banking. But then probably most importantly, we talked about where did we think open banking was going? Like in the next 6 to 12 months, what did we think was going to happen? Obviously, with the CFPB getting shut down, that's where the whole open banking rule came from. It came from out of the CFPB. So that adds a whole nother wrinkle to this. If the CFPB does in fact get shut down, that probably kills the open banking rule. That's probably so maybe, and unless somebody else picks that thing up, it might be dead, at least for a little while. But we'll have to see. But I really thank Mickey Marshall. If he's watching this, or anybody from the ICBA is watching, I really thank you guys for participating and hanging out with me and doing that episode. It was great. It was fantastic. And I'm sure I will have them on again to cover more things in the future. On Thursday, I did a really interesting episode called "Who is Collecting Your Data?" A list of consumer reporting companies. And so so the CFPB put out this report on consumer reporting companies, and it looks at not only the three big credit bureaus, TransUnion, Equifax, Experian, but it also looks at dozens of other companies that collect your data for rent, for employment, like employment background checks. What else was there? So there was rent, employment, just like over. I think there were some other overall credit things and different types of background searches. But the point being there, why I wanted to cover it was because I wanted to show people that there is an amazing assortment of companies that collect your personal data, and a lot of companies on there that you probably have never even heard of. So if you get a chance, I would highly recommend you go look at that episode and check out and see just the sheer number of companies that are out there collecting the information on you from all different angles. It's pretty wild once you see the amount of breadth there of how many companies are out there collecting data on you. It's pretty wild. And then Friday, on Friday, yesterday, I did episode 321, which was called "What is Going On with Auto Repossession?" Again, CFPB just did some new research on auto repossessions. It just looking at, how does it impact consumers when the car gets repoed? What are the fees involved with it? The different types of auto borrowers in the economy. and who is most affected by the repossessions and that kind of thing, and how long does it usually take until the banks start repossessing cars and all that. But it was a really interesting report, really good information there. If anybody, again, has any interest in looking at auto repossessions, is a cool episode to look at, cool report to look at. So that was it. So that was basically the 5 episodes that I did last week. If anybody has not gotten a chance yet, too, I want to put a plug in too for episode 313, which was an interview that I did with Alex Blumstrom from Alex Blum Creates. And that episode was called Talking TikTok and AI with Alex Blum Creates. So Alex Blum is, she's an entrepreneur. She's a business owner, uses TikTok to really market her business. She is, Gen Z. And I thought her and I just had a great conversation on how the ban on TikTok, at least even temporarily, really affected her business. And she gave some great examples of how people can use TikTok to make money, basically with doing like a lot of little side hustles and things like that. So, and then we talked about a little bit about AI. How was she using AI? And basically the thing was, at the end of the day, I mean, instead of hiring somebody, she felt like she could use AI to basically make her a lot more efficient, to the point where she may not have to hire that extra employee right away. And I think that is one of the most interesting aspects there, is that AI does have the ability to make especially smaller companies much more efficient, to the point where, they may not have to hire. Instead of hiring 5 people, they might only need 2. So like I said, so it is an interesting thing to note. And then the other one is, I did a very special episode. Alan Berkeley, a very good friend of the channel, was kind enough to come and join me for what I would basically describe as kind of like a read along. And that was episode 316, which is called Chaos in Kansas, a conversation with Alan Berkeley. And we basically talked about a small bank out in Kansas called Heartland Tri-State Bank, which failed in June of 2023. And it failed because their CEO got involved in what was called a pig butchering crypto scam. And he unfortunately embezzled, tens of millions of dollars from the bank, caused the bank to go under. And we cover an article that was written in Bank Director, and we walk through kind of this whole thing, this whole scenario. And it really is a very interesting, super fascinating story. That episode's a little bit longer. It's about 46 minutes. But if you like a good story, it is a highly entertaining, very interesting story. Alan and I, we really talk about a lot of different aspects there. What happens when a bank fails? How does that affect the community? Why did this person fall for this? This was a trained, seasoned financial services professional. This was a CEO who'd been in banking for 30 years. This was not some Joe Schmo off the street. Like, how did he, he should know better. How did he fall for this? We talked about the failures of leadership. What happens when a board is not paying attention to what goes on? I mean, so we kind of broke down and looked at this thing from a number of different aspects. So again, I think people would really like it. I think if they took some time to listen to it, they would get into it. They'd find it to be a very fun and entertaining episode to listen to. So, okay. So that's the episodes I've got 5 more episodes. I'm hoping some things that people will find very interesting coming out this week. Number of episodes to post, which is great. But now I want to get into some other banking news here. So let's do this. So economic indicators. What do we have coming up this week as far as economic indicators? So on Monday, we have FOMC member Mickey Bowman is going to speak at 10:20. On Tuesday, the 18th, we got the New York Empire State Manufacturing Index. We got the FOMC member Daly is going to speak at 10:20. On Wednesday, February 19th, we get building permits, housing starts, 20-year Treasury bond auction, the FOMC minutes of the meeting. On Thursday, February 20th, we get continuing jobless claims. We get initial jobless claims. We get the Philadelphia Fed Manufacturing Index. We get the U.S. Leading Index. And then on Friday, February 21st, we get the Manufacturing PMI, the Services PMI, the Existing Home Sales, and the Michigan Consumer Sentiment. And then finally, the U.S. Baker Total Rig Count. So again, a little bit of a short week because Monday is President's Day. So a lot of the markets and everything are closed on Monday. But a lot of FOMC stuff. We're going to, a couple members speaking. We get the the minutes of the meeting. We are going to have some housing and some labor market news. So, so we'll see what happens there. So let's take a look. Let's get a rundown here of some of the other stories and things this week. So the Federal Reserve, again, as we talked about a little bit, reporting to Congress, is unsure on the rate outlook. So after cutting rates 100 basis points in 2024, the Federal Reserve will carefully assess incoming data, the evolving outlook, and the balance of risks before considering more cuts, according to its latest monetary policy report to Congress, which I showed you guys a few minutes ago. Treasury names former NCU chair as acting controller. So the Treasury Department announced the appointment of Rodney Hood as acting controller of the currency effective February 10th. Hood previously served on the National Credit Union Administration Board, including serving as chairman from 2019 to 2021. He previously worked in retail finance, commercial banking, affordable housing, and community development in the private sector. Vaught named a CFPB head. He suspends all supervision. We already talked about that. Now, the CFPB's 1071 rule. This is a big regulatory rule that I've talked about in episodes past. This was paused by a court in the ICBA case. So, U.S. Court of Appeals temporarily paused the Consumer Financial Protection Bureau's 1071 small business rule and extended its compliance deadline until further notice, as advocated by ICBA. The U.S. Court of Appeals for the Fifth Circuit granted a request by ICBA and other plaintiffs to suspend implementation of the rule pending their ongoing legal challenge to the rule. And granting the motion to the court, in granting the motion to stay, the court ordered that deadlines for compliance with the rule are hereby tolled or paused. And it says here, the court case has been affected by recent executive developments at the CFPB after President Donald Trump removed Rohit Chopra as CFP director. The Bureau's counsel appeared at oral arguments, but did not argue the case other than to seek a pause in the proceedings, ultimately saying they did not oppose the plaintiff's request for a delay. So again, we shall see what happens with that. That's a big thing. I do believe that Congress really would like to appeal that. That seems to be the way that the wind is blowing at this point. So we shall see what happens there with that. That's to be continued. This is massive. So Jeremy Powell says that there will be no central bank digital currency while he leads the Fed. So Federal Reserve Chairman Jeremy Powell said the U.S. will never have a central bank digital currency as long as he leads the Fed. Testifying before the Senate Banking Committee on the Fed's monetary policy report to Congress, Powell responded to a question from Senator Bertie Moreno, affirming that the country would never have a CBDC under his watch. Well, it doesn't really matter to him because Trump signed an executive order that basically said there will be no central bank digital currency. What worries me, though, is that the Fed was already working on this, and they already had almost in place what was called a wholesale central bank digital currency. In other words, they were working on creating two types of central bank digital currency, a wholesale and a retail. The wholesale was to be used exclusively by central banks. So that was what the Fed would use to basically coordinate and conduct business with other central banks around the world. The retail was for us. That was for individuals, for businesses, for the consumers out there. And so what bothers me is that when I hear Powell say that there won't be a CBDC, there were other comments that we had that I talked about last week where basically they said, well, yeah, there won't be a central bank digital currency, but it doesn't really matter because we already have the wholesale in place. So it bothers me what they've got cooking in the background. And while he says that, oh yeah, we're not going to do that and we're not going to have that, it still bothers me what's going on. I think it's a great step. It's great that that's not going to happen, but it's still a concern. So, but like I said, we'll keep an eye on that one. The OCC withdraws from Climate Group. The OCC said it has withdrawn from the network of central banks and supervisors for greening the financial system, which focuses on climate risk management. Acting Controller Rodney Hood said participation in the NGFS extends beyond the OCC's statutory responsibility and does not align with its regulatory mandate. No beep. Yeah, you guys know the word. Yeah, it's like, yeah, what the OCC and not only the OCC, but what all these other regulatory bodies doing inside these climate groups was ridiculous and absurd. And yeah, should have been allowed. So, okay, what else we got going on here? Okay. The OCC released economic and financial market scenarios for use in upcoming stress tests for covered institutions. The supervisory scenarios include baseline and severely adverse scenarios. Brooke Rollins was sworn in as Secretary of Agriculture after the Senate confirmed her by a vote of 72 to 28. KC Fed, ag real estate values are flat. So agricultural real estate values in the Kansas City Federal Reserve District were flat through the end of 2024, and credit conditions deteriorated slightly, according to the Federal Reserve Bank of Kansas City. Scott and Hill introduced resolution to roll back CFPB overdraft rules. So Senate Banking Committee Chairman Tim Scott and House Financial Services Committee Chairman French Hill introduced ICBA-supported Congressional Review Act resolutions to overturn the Consumer Financial Protection Bureau's final rule capping overdraft fees. If passed by Congress and signed into law by President Donald Trump, the resolution would invalidate the CFPB's rule, which would cap fees at financial institutions with more than $10 billion in assets. Hill and Scott cited the rule's impact on access to important financial services and said lawful and contractually agreed upon payment incentives promote financial discipline and responsibility. So I think that is a good thing. ICBA state associations support Bowman for supervisory role at the Fed. So ICBA and its affiliated banking associates this week urged the Trump administration to nominate Federal Reserve Governor Michelle Mickey Bowman for a full term as vice chair for supervisor at the Fed. I think that'd be a great thing. We'll have to see what goes on. ISO 20022 implementation for FedWire funds pushed to July. So the Federal Reserve delayed until July 14th the transition of its FedWire fund service to the ISO 20022 message format to give financial institutions and vendors more time to prepare. The transition was previously slated for March 10th. I'm going to go over some of this stuff in a second. Fed's Waller, amid uncertain stablecoin outlook, legislation should address risk. So whether stablecoins will scale for retail payment use cases remains to be seen. Federal Reserve Governor Christopher Waller said, speaking in San Francisco, Waller said such an evolution will require both a substantial number of consumers to shift their preferences toward using stablecoins and a significant number of businesses to make necessary investments to receive payments via stablecoins. He noted that fragmentation around the use and acceptance of stablecoins will also act as an impediment to scaling and will impact how stablecoin use cases developed. Waller also reiterated that any stablecoin legislation should provide for supervision and regulation of stablecoin issuers that is proportionate to the risks they pose, given the public sector's role of creating a fair set of rules for market participants. Everybody may recall I did an episode covering some reports that it came out basically on the effects of stablecoin on the financial system, and that basically stablecoin does have the ability to crash and thusly could crash the financial system if it were ever, ever rolled into the financial system, as it were. ICBA congratulates Jonathan McKiernan on his nomination to serve as director of the Consumer Financial Protection Bureau, and Jonathan Gold on his nomination to serve as controller of the currency. So basically what happened here toward the end of the week is, as after Russ Vought got put in as chairman, then we had Russ Vought then turned it over to Jonathan McKiernan. So Jonathan McKiernan is now head of the CFPB, and we'll see what he does with it thereafter. And then Jonathan Gold is now serves as controller of the currency. So that's good news. ICBA state associations support Bowman for supervisor role at the Fed. Yeah, we already went over that. ICBA weighs in on the stablecoin debate. So ICBA told Congress that current stablecoin arrangements are not subject to comprehensive supervision and lack many critical consumer and anti-money laundering protections. A regulatory gap that allows risks to the financial system to multiply, provides opportunities for financial crimes, and creates an unequal playing field with highly regulated community banks. SEC reverses course on ICBA opposed climate rules. So acting Securities and Exchange Commissioner Chairman Mark Yeida, if I'm saying that right, Yeida, said his agency will seek to freeze court proceedings and a legal challenge to its final rule requiring climate-related investor disclosures, citing his opposition to the rule. He said he has directed SEC staff to ask the Eighth Circuit to not schedule the case for argument while the commission determines appropriate next steps, citing his and Commissioner Peter Pierce's votes against the SEC rule, opposition by many public commentators, weighty questions about whether the SEC has the statutory authority to issue the rule, concerns about the agency's evaluation of costs and benefits, the recent change in composition of the agency under the new administration, and President Donald Trump's rulemaking freeze. So yes, just like what I just said a few minutes ago about the OCC pulling out from the climate pact that it was in, the same thing poses here for the SEC. So get it out and get it gone. Okay. Now let's take a jump back into some articles here with the time that we have remaining. Let's jump back in. So let's take a look at inflation. How was the Federal Reserve doing with inflation? Not too good. Consumer prices rise 0.5% in January, higher than expected as annual rate rises to 3%. The CPI accelerated a seasonally adjusted 0.5% for the month, putting the annual inflation rate at 3%. Pretty close to the Fed's 2% target, right? Both higher than expected. The core CPI ran at 0.4% and 3.3% respectively, also above forecast. Shelter costs continue to be a problem for inflation, rising 0.4% on the month. Food prices jumped 0.4% and energy prices climbed 1.1% as gasoline prices increased 1.8%. Markets largely expected the Fed to stay on hold for an extended time and pushed the next rate cut probably out to September following the CPI report. Okay, excluding volatile food and energy prices, the CPI rose 0.4% on the month, pushing the 12-month inflation rate at 3.3%. But what I was more curious about was the core. The annual core rate was also up 0.1%. But I thought the core, let's see here. So I think the core is running at 3.3. So the CPI is running at 3% and the core is at 3.3. Like I've been saying again the last couple of weeks. So we're seeing inflation go back up now. We're seeing inflation go back up, which is a bad thing. And so again, the Fed is not controlling inflation. They should not have cut interest rates 5 months ago. They should have left interest rates alone, and then this would not be happening right now. And again, this is why I'm saying this was a horrible pivot by the Fed. So, and then here's the inflation breakdown for January 2025 in one chart. So let's take a look here. What do we have here? So here's the inflation breakdown. These are some of the core categories plus other items with notable year-over-year price increases. So all items, 3%. Food at home, 1.9%. Food away from home, 3.4%. Energy, 1%. All items less food and energy, 3.3%. Let's take a look at this. Eggs up a whopping 53% for eggs. 53%. Other condiments, 10.3%. Uncooked beef roasts, 7.5%. Instant coffee, 7.1%. Bacon, 6%. Beans, peas, and lentils, 5.6%. Uncooked ground beef, 5.5%. Candy and chewing gum, 5.4%. Tea, 3.7%. Ham, 3.6%. Fresh sweet rolls, sweet rolls, coffee cakes and donuts, 3.5%. Lettuce, 3.3%. Cookies, 3.1%. Food away from home, food in employee sites and schools, 3.8%. Energy, gas services, 4.9%. All items less food and energy. Video discs and other media, 19.6%. Motor vehicle insurance, 11.8%. College textbooks, 10.7%. It just goes on and on and on and on. And so again, I ask, does this look to you like the Fed is doing a good job managing inflation? Does it look to you like we should continue cutting rates? I would say no. Let's look at the PPI. Producer prices report points to softer Fed inflation measures than feared. The producer price index increased by seasonally adjusted 0.4% on the month compared with the Dow Jones estimate for 0.3%. Stock market futures moved slightly higher following the release, while Treasury yields fell. Wall Street strategists cited details of the report that suggested a slightly more benign inflation picture. A gauge of wholesale prices rose more than expected in January, though some details of the report indicated that pipeline inflation pressures are easing. The producer price index, which measures what producers get for their goods and services, increased by a seasonally adjusted 0.4% on the month, compared with the Dow Jones estimate of 0.3%. Excluding food and energy, the core PPI was up 0.3% in line with the forecast. In particular, some costs related to healthcare showed easing. Physician care, for instance, fell 0.5%. All domestic airfares declined 0.2%. The brokerage services prices were off 2.2%. Over the past year, all items PPI increased 3.5%, well ahead of the central bank's objective. Futures prices indicates the market now does not expect the Fed to lower its benchmark interest rate again until October. So 2 days earlier, they were saying, well, it may not be until September. Now we're saying October, but wait, there's more. Oh, look at this. Bank of America CEO on inflation impact on U.S. economy. Rates are going to stay where they are. Wow. Bank of America CEO Brian Moynihan said Wednesday that strong consumer spending so far this year means that the Federal Reserve will probably hold off on cutting its benchmark interest rate. The bank's retail customers are spending about 6% more money in the first 40 days of this year compared to the same period in 2024. That's driving price firmness, demand firmness, Moynihan said. You're seeing activity that says that we're probably in a period where rates are going to stay where they are for a while until this settles in. Yes, the Bureau of Labor Statistics reported hotter than expected growth in U.S. Consumer Price Index earlier Wednesday, forcing markets to recalibrate rate expectations. The Fed began an easing cycle in September, reducing rates for the first time since the 2020 pandemic, but the central bank is seen as limited in how much it can cut by stubborn inflation. Last month, the Fed opted to keep its benchmark rate unchanged. Rates are restrictive, but there was not enough sort of inflation progress that we made to cut rates, Moynihan said. Yes, absolutely. Bank of America research analysts expect no rate reductions in the immediate future because of elevated inflation, he added. So we went in the course of a few days with the inflation data, the CPI, the PPI, we went from, we're not going to cut rates until September. We're not going to cut rates until October to, rate cuts are off the table for this year. That's where we went in like 3 days. Pretty amazing. But this is what I get back to at the very beginning here. We've covered a lot of ground here in an hour and a half. We started out looking at all these charts here at the beginning of the night. We looked at the Fed's balance sheet and what's going on here. We looked at the money supply. We looked at the repo market. We looked at the price of gold. We talked about Jeremy Powell's comments this week. We talked about why the Fed is powerless to lower housing inflation. And, we talked about what was going on in the Treasury market here, or what the Treasury plan was. And now we've talked about all the inflation data, the CPI. Based on Powell's comments on Wednesday, is it basically saying, everything's not too bad. We're working on getting inflation back down to 2%. I have said for the last couple of months, inflation it's stalled at about 2.6%, but the core numbers were up higher. And there was nothing that suggested that the inflation numbers were going to come down to meet the Fed's mandate. So if inflation is way up higher, if inflation's running at anywhere between 3 and 3.5% right now, and it's starting to tick back up, and the labor market is nowhere near as strong as what they project, what does that tell you about what the Fed is doing right now? Does that maybe suggest the Fed might be losing control of what's going on here with the economy? Yeah, I think so. I think so. I think that their pivot, reducing the interest rates while at the same time keeping the tightening on by continuing to dramatically reduce their balance sheet. That is a toxic brew right there. It's a toxic brew, and it is going to dramatically hurt us here. Dramatically hurt us. But okay, let's keep going here. So what happened with retail sales? Oh, retail sales slumped 0.9% in January, down much more than expected. Retail sales slipped 0.9% for the month from an upwardly revised 0.7% gain in December, worse than Dow Jones' estimate for a 0.2% decline. Excluding autos, prices fell 0.4%, also well off the consensus forecast for a 0.3% increase. That leaves a question. Did consumers experience a holiday hangover in January? Some key takeaways. U.S. retail sales surprised economists by falling 0.9% in January, much steeper than anticipated. As economists said, some consumers may have already taken the month off after splurging during the holiday shopping season. Car sales experienced the steepest decline, but sales of sporting goods, electronics, and furniture also all dropped in January after recent strong months. December sales results were adjusted higher to make January's decline steeper, with economists forecasting improved sales in coming months. So, yeah, so I think there's some, I mean, obviously no reason necessarily to panic in retail sales, but I think that there is a legitimate, did we have a hangover effect of some kind in January? And I would say, yeah, we probably did. Mortgage refinance demand jumps to highest level since October, but home buyers pull back again. The average contract interest rate for 30-year fixed rate mortgages with conforming loan balances decreased to 6.59% last week. Applications to refinance a home loan jumped 10% compared with the previous week and were 33% higher than the same week 1 year ago. Applications for a mortgage to purchase a home declined again, falling 2% for the week. Trump takes aim at wasteful government spending by ordering end to penny production. That's kind of interesting. So there could be an end to the penny, which would be kind of interesting, but we'll see what happens with that. What dismantling the Department of Education could mean for colleges, student loans, and college access. As an agency authorized by Congress, the Education Department cannot be eliminated without congressional approval. But in the meantime, the Trump administration, Elon Musk, and his Doge team can slowly cripple it. While some of the department's programs may be transferred to other agencies, that transition could cause major disruptions to the nation's $1.6 trillion student loan program, experts say. Yes, I'm sure that there may be some disruption in the short term, but I think the Department of Education is a giant, massive waste. And there needs to be, even if you don't get rid of it, there needs to be massive reform with the Department of Education. And when you just look at the numbers, the Department of Education was created in 1979 during the Jimmy Carter administration. I would challenge anyone to look at the test scores, look at the different things that the Department of Education has done in the 45, 46 years that it's been around. And you tell me if anything has improved, anything at all. And I would say nothing has. So something's got to give there. So I'll leave it at that. Trump signs order to impose 25% tariffs on steel and aluminum. Here are the likely winners and losers. So we'll kind of take a look at that more in coming weeks. There was another thing. Trump signed sweeping reciprocal tariff plan. So that's another interesting thing that we'll cover that more in the weeks ahead. I thought this was interesting. Zelle payments top $1 trillion in 2024 as network's growth outpaces rivals, including PayPal. So Zelle crossed $1 trillion total volumes last year, which it said was the most ever for a peer-to-peer platform. The payments network said its user base jumped 12% to 151 million accounts in 2024, and that the total dollars sent on the platform jumped 27% from the year earlier. Zelle was launched in 2017 in response to the rise of platforms such as Venmo, PayPal, and Cash App. So very interesting stuff there. This is kind of a funny headline. A Rothschild, the House de Rothschild, who crusaded for kinder capitalism just to the Trump era. I love it. Yeah, a turn against do-gooder capitalism. That would be stakeholder capitalism. All just imagine all the nonsense that gets pushed out of the WEF, the World Economic Forum, which of course is supported wholeheartedly by the Rothschild clan. Yeah, all their nonsense. This basically gets into the whole like DEI stuff. All the DEI stuff is beginning to fall by the wayside, and she's got the sads. She's got the sads about it. Yeah, they better get used to it because that's where we're going. Okay, TD Bank to sell its $15 billion stake in Charles Schwab as asset cap fallout continues. Yeah, TD is going to have some problems here in the next few years. They're going to continue to have some issues as they continue to deal with the salary cap. This one did not make me happy. SBA's flagship small business lending program is in the red, and here's how it could hurt businesses. So the last administration basically ran the SBA into the ground. That makes me very upset because the SBA has been one of the few gems in the government over the course of the last few decades. And the SBA has always been an department that was well run, that made a lot of generated profits every year. It's actually a self-sustaining government agency that generated profits every year. Not so right now. And they've got a lot of work to do to clean that thing up. They made a lot of stupid decisions there at the SBA over the last 4 years, and really the leadership was taking it in a very bad direction. Hopefully, the people now can basically get things back to, hopefully turn it around and get things back to normal. The Trump administration is likely to ditch the non-compete ban, but others are clamping down. So yes, so the Trump administration is probably looking to get rid of this ban on non-competes, but you have a number of states right now that are basically fighting back, basically trying to make the ban permanent, which is kind of strange to me because the non-compete ban is a very important thing. There are certain industries that you have to have non-compete clauses to operate. You just have to have them. But like I said, we could talk about that another time. We can get into that. And then this article, last article, I'll leave everybody with this. So inside Amazon's messy push to bring everyone back to the office. So I just thought this was kind of funny. The 5-day policy dials back flexibility that predated the pandemic. Employees are returning to find they have no desks, not enough parking, and still endless virtual meetings. So I think one of the drawbacks to bringing everybody back is the fact that a lot of the companies out there decreased their office space when a lot of their employees went to remote work. They decreased the office space, and a lot of times going to nicer office space, but smaller office space. And now all of a sudden they want to bring all the employees back, and they're like, yeah, we got nowhere to put them. And that was actually something that was a thought that had occurred to me probably about a year ago. I was sitting there just sitting there one day, and I was going, what would happen if all these companies decided to end remote work one day and bring everybody back? How would they do that if they dramatically reduce their office footprint? It would kind of be a problem, right? So again, I'm not totally surprised by this. It's not shocking. I just like I said, I just found it kind of funny. Whoops, whoopsie. So we'll have to see what happens. But I would not be surprised to see a few more articles like this in the future. We'll have to see what happens. So, all right. Oh, last thing before I forget. So I did say this earlier. So I've got some books that I want to cover here in the coming months that I think are very critical books. I got some interesting books that I'm going to do reviews on. So I don't know if anybody's ever heard of John Law. So this is called Millionaire. It's the story of John Law. He was the philanderer, gambler, and duelist who invented modern finance. So if you've ever seen The Wolf of Wall Street, just think of The Wolf of Wall Street, only it takes place in the 1700s. And what was the guy? What was The Wolf of Wall Street? What was his name? Gosh, I'm drawing a blank on his name now. Well, instead of his name, it was a guy named John Law. So, but absolutely incredible Absolutely incredible story about how he kind of took the economy in France to heights, and then it all crashed back down. Here's another very interesting story. This is called The Exchange Artist, and this is called High Flying Speculation and America's First Banking Collapse. So this was a great story that I can't wait to dig into this one, and then bring hopefully a regaling tale. This is one that I want to cover that may or may not be a little controversial to some people. One of the all-time classics, Trump, The Art of the Deal. Now, why do I want to cover this book? I want to cover this book for a number of reasons. I read this book for the first time back in 1994. I remember it because I had to do a book report for school, and we had to pick the assignment was to basically pick a profession, and then read a book about that profession and then write about it. And so I read the book, The Art of the Deal. My father had a copy of this, and then I ended up getting a much newer copy of this. But I was fascinated. When I read this, I was fascinated by the life of a real estate developer. I still think it is one of the best books, not only from a business standpoint, but also from just trying to understand, like, what does a real estate developer do every day? Like, what do they do? How do they do it? And he gives examples of a number of deals that he did. So I think understanding it from a business perspective is good, but I also think that it's insightful into understanding President Trump, the man, understanding him from a negotiator point of view. Like, and I bring that up because of the tariff stuff, all the tariff stuff going on. I think that if you read that book, you will get a much better understanding of him from a negotiation style, the way that he thinks about things. And I think if you read that, you'll get much better insight into the man and his business philosophy, so to speak. So, and then obviously trading with intermarket analysis, what I talked about earlier. I want to talk about that. This book, very interesting. Robert Higgs, Crisis and Leviathan, Critical Episodes in the Growth of American Government. This book is an absolute classic. And this is basically talks about how Crisis and Leviathan, in other words, how does the federal government continue to keep getting bigger and bigger and bigger with every crisis? And that's thus the name, Crisis and Leviathan. You have the crisis, and then the Leviathan, being the government, just continues to grow larger and larger. The largesse, if you will, of the federal government. How does that continue to grow? So this is a great book for this. And Robert Higgins, I think he wrote this book in the 90s. And then when did he write this? He wrote this in, I think it was in 1990. I'm sorry, 87. He wrote this in 87, but it's become an absolute classic. Again, if you want to understand the growth of government. I wanted to cover these books, Currency Wars by James Rickards, and then his brand new book here, Money GPT, AI and the Threat to the Global Economy. Currency Wars, to me, is an absolute business classic. If you like it looks at things from a very different perspective. Almost if you talk about people talk about like playing 3D chess and looking at things from a very different strategic position. James Rickards, he does that. And Currency Wars is mind-blowing because it basically talks about, it's the first book that I really had ever read that really dug deep into economic warfare and how different currencies and how different countries can war with each other economically. And as a business guy, as a banker, I found it absolutely fascinating. And he does that same thing here with Money GPT, AI and the Threat to the Global Economy, where he takes the same kind of philosophy that he laid out in Currency Wars, and he looks at it now from AI. Like, how is AI going to affect this? Basically, how could AI affect global economic warfare, and posing different stories and different scenarios for how AI could affect the economies of the world in different ways, and if it's used in bad ways by bad actors, what happens with that? And then finally, I have a number of books here I love the Wiley Investment Classic series, and I have a number of books here. I got Common Stocks and Uncommon Profits, Super Money, Where Are the Customer's Yachts, The Alchemy of Finance, Reminiscence of a Stock Operator, The Battle for Investment Survival, all investment classics for all different reasons, and I will cover all those books and get into all of them in the future, and basically go over why it's worth reading those books. They all have very important things to say from all different kinds of perspectives of finance. But so those are some of the books here that I want to cover. But again, not in a week or two, but probably over the next 6 months, I'll spend time going through all of these books, and I'll go back and forth over some of these things, because some of these things have a lot of valuable lessons that we'll be learning, discussing, and applying to the things that we talk about here week in and week out. So, all right. So with that being said, I'm going to wrap up by basically saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments, as I always love getting back to everybody. As I always remember to check out other content on the channel. I like to think I put up some pretty good episodes and some pretty good things, all things banking and finance related, that hopefully people will love. And I hope everybody has a wonderful weekend. Enjoy the President's Day holiday, and I will see everybody again next week. Thanks a lot, and God bless.